$27. 22 million can move tax-free to your kids right now, but that window closes in 18 months, and most families don't realize it. In the next 10 minutes, we're breaking down the exact 3 IRS-approved methods that let you transfer $500K to the next generation with zero federal taxes under current law. Why a single decision could save your family $240,000 in preventable estate taxes, and the specific IRS publications that prove it. Let's start with understanding the current landscape. As of 2024, the federal estate tax exemption sits at $13, 61 million per individual, or $27, 22 million for married couples filing jointly. However, and this is critical, this exemption is scheduled to sunset on December 31, 2025. When 2026 arrives, unless Congress takes action, that exemption will cut in half to approximately $7 million per individual. This isn't theoretical, it's baked into current law under the Tax Cuts and Jobs Act of 2017. The Congressional Budget Office has stated that without legislative intervention, this reduction is automatic. Why does this matter? If your family has $500K or more in assets, and that includes your home, retirement accounts, business interests, and investment portfolios, you could face a federal estate tax rate of 40% on every dollar above the exemption threshold. That means $200,000 of your $500K inheritance could vanish in federal taxes alone. For $1 million estate, that's $400,000 in potential taxes. The wealth transfer strategy you choose today will determine whether your heirs receive your full legacy or whether the IRS becomes your largest heir. Method 1. Direct exemption utilization, the most straightforward approach. The first strategy is the simplest. Directly gift assets up to your current exemption amount. IRS Publication 559 and Form 709 are your foundation documents here. Here's how it works in concrete terms. Consider Sarah and Michael, a married couple with a $3 million portfolio split between investment accounts and real estate. They have 3 adult children. Under current law, Sarah can transfer $61 million tax-free, as can Michael, by filing a timely gift tax return, Form 709. Before the 2026 deadline, they can gift $500K directly to each child, $5 million total, without triggering any gift tax and without reducing their individual exemptions below the post-2026 levels. The mechanics are straightforward. They work with their estate planning attorney to execute irrevocable gift letters documenting the transfers. These gifts are made from their taxable estate and effectively freeze those assets outside the taxable estate at their current value. If those $500K in assets appreciates to $700K by the time of death, Sarah and Michael's estate avoids taxes not just on the original $500K, but on the $200K appreciation as well. One critical counterargument you'll hear: isn't it better to wait until death when assets get a stepped-up basis? This argument has merit, but only partially. When someone inherits assets at death, those assets receive a stepped-up basis, meaning if you bought Apple stock for $100 and it's worth $1,000 at death, your heirs inherit it at the $1,000 basis and owe no capital gains tax on the $900 appreciation. However, this benefit becomes irrelevant if your estate exceeds the exemption. The 40% estate tax destroys any stepped-up basis advantage. As wealth advisor Tom Blanton notes, the stepped-up basis is a tax benefit only if you avoid the estate tax in the first place. But here's the nuance. For appreciating assets, the direct gift strategy becomes even more powerful. If you gift $500K in growth stocks to your child today, and those stocks double to $1 million by the time of death, the $500K original gift is outside the taxable estate, and your child receives it at a stepped-up basis of $1 million. The result: 0 capital gains tax on the appreciation, plus 0 estate tax on the original $500K. You've achieved both benefits. Method 2. Irrevocable life insurance trusts, ILIT. The leverage strategy. The second method is more sophisticated, structuring life insurance through an irrevocable life insurance trust. This strategy, documented in IRS Publication 560 and Treasury Regulation 2053-1, allows you to leverage your exemption. Here's the mechanism. You establish an irrevocable trust and fund it with enough money to pay life insurance premiums. The trust owns the policy, and upon your death, the death benefit flows directly to the trust, completely outside your taxable estate, provided the trust is properly structured and you don't retain incidents of ownership. Consider Robert, a 55-year-old business owner with a $4 million estate. He's concerned about estate taxes, but also wants flexibility. He establishes an ILIT, funds it with $50K of his current exemption, and the trust uses that $50K to purchase a $500K 20-year term life insurance policy. When Robert dies at age 75, the $500K death benefit flows tax-free to the trust, then to his beneficiaries. Robert has effectively converted $50K of exemption into $500K of tax-free wealth transfer, a 10x leverage ratio. The tax code allows this through what's called the crummy provision, named after a court case. By giving trust beneficiaries the right to withdraw contributions for a limited period, typically 30-60 days, these gifts qualify as present interests rather than future interests, allowing them to fit within the annual $18,000 gift tax exclusion per person. For a couple with 3 children, that's potentially $108,000 per year in gift tax-free transfers that fund the insurance. However, there's an important caveat. IRS strategies require discipline. You must fund them consistently with gift tax returns, properly document crummy notices, and avoid retaining any control over the policy. One error, such as the grantor maintaining a power to withdraw funds, and the IRS could argue the policy belongs to your estate, destroying the entire strategy. The IRS has successfully challenged improperly structured IRS in several high-profile cases, including estate tax disputes involving assets exceeding $10 million. Method 3. Grantor Retained Annuity Trusts, GRAT. The growth optimizer, the third method, is the most aggressive for asset growth scenarios. A grantor retained annuity trust, outlined in IRS Publication 550 and Treasury Regulation 2702-1. GRAT works like this. You transfer appreciated assets into a trust, retain the right to receive annuity payments for a specified term, typically 2-10 years, and anything remaining in the trust after your annuity payments stop passes to beneficiaries with minimal or zero gift tax. Example: Jennifer owns real estate currently valued at $500K, but expects it to appreciate significantly due to planned commercial development. She creates a 5-year GRAT, transfers the property into it, and retains the right to receive annual annuity payments of approximately $100K. The IRS calculates the remainder interest, the value of what passes to beneficiaries, using a formula that includes current interest rates. As of 2024, the 7,520 rate is approximately 6.5%. If the property appreciates beyond the IRS assumed return, that excess appreciation passes to her children tax-free. Here's the power. If Jennifer's property appreciates from $500K to $900K over the 5-year term, she's received her annuity payments, her original investment back, and the $400K appreciation transfers to her children with zero additional gift tax. She's used her strategy to make the appreciation, not the original asset, transfer tax-free. The downside: GRAT are complex and require precise timing. If you die during the trust term, the entire property reverts to your taxable estate, losing the benefit. Additionally, GRAT work best during high interest rate environments where remainder values are smaller. During low interest rate periods, remainder values are higher, requiring more exemption use. The 2017 Tax Cuts and Jobs Act also introduced a throwback rule, making short-term GRAT less efficient, which is why most planners now recommend longer-term 10-year GRAT. Why 2026 is your deadline. The data. According to the American College of Trust and Estate Council, approximately 2,000 estates per year currently face federal estate taxes. However, projections from the Tax Foundation suggest that number could increase to 4,500-5,000 annually once the exemption drops in 2026. For families with $500K to several million in assets. The difference between acting now and waiting is the difference between their heirs receiving full inheritance or the government taking 40%. Specific example: a family with a $2 million estate in 2024 faces zero federal estate tax. If that same family takes no action and their estate still equals $2 million in 2026, they'd owe federal estate taxes on the $1 million exceeding the new $7 million exemption threshold, approximately $400,000 in federal taxes. Critical action steps. First, document your current exemption usage with your estate planning attorney before December 31, 2025. Every gift tax return filed before this deadline locks in your current exemption amounts under existing law, even if exemptions drop in 2026. Second, audit your asset values. Gifts should be made at current fair market value. Undervaluing assets exposes you to IRS challenge. Professional appraisals for real estate and closely held business interests are non-negotiable. Third, execute irrevocable documents. Once you gift assets or establish a trust, you cannot change your mind. This is the trade-off for the tax benefit. Finally, coordinate with your tax professional. These strategies interact with state estate taxes, income tax considerations, and family dynamics. A $500K gift to one child, and not another, could